I'm Bill Cannon, Head of Investments at Valkyrie, and here's this week's macro summary. Fears of recession are becoming a reality as the inflation story turned to big-name retailers missing earnings expectations last week, pushing strategists' call for a sign of initial support at current levels. Market volatility looks to remain in the near term ahead of economic indicators released this week. Investors are focusing on all data to try and see where a bottom could form ahead of what could be a drawn-out period of higher than desired inflation and stifled growth. The S&P 500 index was down 20% year-to-date for part of Friday following retailers' earnings earlier in the week. A strong Friday afternoon rally managed to keep levels slightly down for the week, which carried through the weekend. The S&P 500 recovered to about 16% year-to-date. The Nasdaq Composite behaved similarly with a dip mid-Thursday before a rally weekend eve. With the index at 11,500, it is down about 26% year-to-date. The 10-year Treasury yield reached 3% mid-Wednesday before turning notably lower to the 2.77 level for the week. Crude oil futures followed general market movement lower Wednesday through Thursday to the $106 per barrel level as demand would soften in a downturn. But the late Thursday rally proved strong and now approaching $114 per barrel after the weekend. Using the euro currency as an example, the US dollar has strengthened this year to levels not seen in decades. What seemed like a move to parity with the dollar last week, the euro moved off lows, trending higher to $1.07 per euro. The new week is busy with daily economic indicator releases. Following the third straight month of weaker existing home sales due to rising mortgage rates and record level of home prices last week, new home sales will be released Tuesday and are expected to follow in similar manner, with expectations at 750,000, down from 763,000. U.S. initial jobless claims is released Thursday, with expected claims at 215,000, down from 218,000 last month. For quick reference, which could provide some context to what beneficials might be looking at, current level is low relative historical metrics, showing average levels closer to 400,000. Average for 2022 to date is just lower than 200,000, while 2021 was about 450,000, and 2020 average was almost 1.5 million. Looking further back, average claims for this period, for the period 2000 to 2019, was about 350,000, then about 375,000 for the period 1980 to 2000. The Personal Consumption Expenditures Index is the Fed's preferred inflation gauge, and Friday's release looks to continue the historically high levels at an expected 6.2% year over year, down from 6.6% last month. Personal income and spending look to decline slightly month over month as well, which could provide more color ahead of the next Fed meeting mid-June and provide investors the data they need to plan the next move.